What is an account receivable? Accounts receivable is also known as trade receivable. Accounts receivable is a current asset account in which a company records the amounts it has a right to collect from customers who received goods or services on credit. Explain accounts receivable cycle. The accounts receivable cycle usually involves a straightforward process for alerting customers and clients about the money they owe. A standard accounts receivable workflow includes the following steps. The initial agreement or sales conversation. Reminders at set intervals for outstanding invoices. The creation of an invoice with a specific due date. Updating the accounting software to reflect payments that have been received. What is purpose of accounts receivable turnover ratio? The main purpose of the ratio is to measure the amount of time it takes for a company to collect their accounts receivables on an average basis. It can be used to determine if a company is having difficulties collecting sales made on credit. Formula. Turnover ratio equals net sales, average net receivables. What is the days sales in accounts receivable ratio? The days sales in accounts receivable ratio means the number of days it took on average to collect the company's accounts receivable during the past year. It is also known as the average collection period. What is deferred revenue? It refers to a prepayment for services or products recorded on a company's balance sheet. Deferred revenue counts as a liability. What is a bank reconciliation? It is an important step in the accounting process that provides an internal control for businesses and organizations. Can you explain inventory turnover ratio? Inventory turnover is a ratio measuring the number of times that a company has replaced its inventory balance in a specific period. A company's inventory turnover is often expressed as the company's cost of goods sold, COGS, for a year divided by the average cost of inventory during the same year. The result of this calculation is the inventory turnover ratio. Inventory turnover equals COGS, average inventory. What is the reorder point? The reorder point is the quantity of units in inventory at which time an order should be placed to purchase additional units. What is bad debt? The term bad debts usually refer to accounts receivable or trade accounts receivable that will not be collected. Or a bad debt is money somebody owes that the creditor clearly identifies as not being collectible. Who's the factor? The factor is a financial company or bank that purchases receivables from businesses and then collects payments directly from customers. What is the 13-point average for inventory? The 13-point average for inventory for the calendar year 2022 would be the sum of the following. The inventory amount at December 31, 2021 plus the 12 end of the month amounts in 2022, divided by 13. What is the operating cycle? The operating cycle tracks the number of days between the initial date of inventory purchase and the receipt of cash payment from customer credit purchases. The operating cycle is used to calculate accounts receivable turnover, inventory turnover, average collection period, accounts receivable days, and average payment period, inventory days. Operation cycle equals days inventory outstanding plus days sales outstanding. What is the working capital turnover ratio? The working capital turnover is a ratio that compares the net sales generated by a company to its net working capital, NWC. Working capital turnover ratio equals net sales, NWC. What is average collection period? The average collection period is the average number of days it takes a business to collect and convert its accounts receivable into cash. The formula for calculating average collection period is average collection period equals accounts receivable sales x number of days in a year. Or average collection period equals 365 days accounts receivable turnover ratio. How much time needs to pass for an accounts receivable account to be considered delinquent? After 90 days of the due date. What does goodwill mean? Goodwill in accounting refers to an intangible asset. It occurs when one enterprise buys another business and spends a higher price for it when compared to the net assets of the company they are buying. What are trade receivables? Trade receivables are amounts owed by customers for goods and services sold in the course of a firm's ordinary business, trading, activities, including all accounts receivable and all notes receivable resulting from trade activities. Calculate trade receivables with the formula. Trade receivables equals debtors plus bill receivables. What are the non-trade receivables? Some examples of non-trade or other receivables include interest receivable, income tax receivable, receivables from employees, insurance claims receivable. What are the examples of other receivables? Interest receivable, loans to company officers, advances to employees, income taxes refundable. What is the main source of receivables? Credit sales of goods and services. How many bases are used to estimate the allowance, and what are they? Two bases are used to estimate the allowance, 1% of sales and 2% of receivables. Which method of accounting for bad debt is not acceptable for financial reporting purposes? The direct write-off method. What is the aging of accounts receivable? It is the analysis of customer balances by the length of time they have been unpaid. What are operating assets? Operating assets are necessary to a company's ongoing core operations and directly support the continued generation of revenue and profits. Operating assets net equals total assets non-operating assets. Common examples of operating assets include the following: property, plant and equipment, PP&E, accounts receivable, inventory, recognized and tangible assets, e.g., patents, intellectual property. What is assignment of accounts receivable? Assignment of accounts receivable is an agreement in which a business assigns its accounts receivable to a financing company in return for a loan. It is a way to finance cash flows for a business that otherwise finds it difficult to secure a loan, because the assigned receivables serve as collateral for the loan received.